Outlook on yields this year is a function of a number of things. Our outlook on inflation rate, exchange rate, and what is happening in the global markets, we definitely guide this to a larger extent. What we think is that so long as there's pressure on exchange rate, looking at what is happening in the US, given the new guidance by the Fed that the Fed fund rate is going to be increased about 3 times in 2017, and the inflationary pressure also continue. There's a likelihood that an uptick in yield should continue. But looking at the base effect of inflation in Nigeria and the likelihood that the authority might want to do something that is, much more efficient in terms of managing what's happening in the FX market, we may likely see some moderation in yield this week. Because what happened last year, as against what we saw in the first half of the year, where yields were a little bit moderate, we saw a lot of spike in yield in the second half of the year when CBN started the aggressive mop-up of the liquidity in the system, and we saw yield, just like you mentioned, touching the highs of about 18%, most especially at the shorter end of the curve, where investors were really concentrated on. For example, money markets average rate in the T-bills market rose from an average of 10.8% in the first half of the year to something in the above 18%, 18.2 to be precise, in the second half of the year, even higher than the average yield in the bond market. Although on an annual basis, bond market yields were higher, but we saw a lot of activity at the shorter end of the curve because of overall pressure on the economy and aggressive mop-up by the CBN just to check excesses at the currency market.
But then that didn't really affect the yield curve, the yields on most of those bonds, as you actually mentioned. We saw that heading towards 20%, about 18.2%, like you already mentioned. But do you think it's sustainable, bearing in mind that the dynamics have really not changed with regards the risk around interest rates, currency, and inflation, even though it seems to be still early days yet, but already we see the handwriting on the wall. Most likely, these rates will continue to be a major concern.
No doubt. The pressures are still there. Government still need a lot of financing. Budget is still going to be largely financed by debt, and the pressure on inflation, exchange rates are still there. The sustainability of the yield in the system, we definitely depend on this factor. Long as there's pressure on general price level, long as exchange rate is challenged, long as currency is a problem both in the domestic and the external sector, investors will need to ask for more premium on what they are getting in the fixed income market. And of course, government need a lot of debt. They will need to finance this and to get investors to buy this instrument. They will need to give them something that is in excess of inflation. And based on what we've seen last year, that's what they've been guiding. Sustainability will depend on how they use policy to guide these variables.
Then while Nigeria is issuing a $1 billion Eurobond this month, and the dollar is starting the year on a bullish note, how much will this affect pricing?
Well, if you look at what happened to the Eurobond market, Nigeria Eurobond were priced at a huge discount because of the current currency crisis in Nigeria compared to related markets in Africa. So we think the prices are still going to be guided by the pressure that investors would like to price into what is happening in Nigeria. So where you see the currency market crisis is not yet resolved, investors will probably want to ask for premium for currency risk and the likely downgrade of the Nigerian bond. So I think these are some of the issues that will definitely guide the rate at which this will be issued. But I think for the bond to be even successful, investors are still asking what is going to happen to the exchange rate. So I think these are the issues to be really concerned about.
Wale Olusi, investment research analyst with AfriInvest, thank you so much for joining me on the program this morning and sharing your perspectives.